My name is Nurul Kisina Batrusha binti Shamuddin. My matrix number is for F1128. Today, I will explain about current liabilities. Current liabilities are obligations or debts that a company is expected to settle within 1 year or one operating cycle, whichever is longer. These liabilities arise from the company's normal business operations and are usually paid using current assets such as cash or accounts receivable. Some common examples of current liabilities are account payables and bank overdraft, which I will explain in the next slide. Now let's move on to the first type of current liabilities, which is account payable. Account payable or AP is the amount of money a company owes to its suppliers for goods or service purchased on credit. This means the company has already received the goods or services but has not made the payment yet. It is classified as a current liability because the payment is normally due within 1 year.
Alright, hi everyone, my name is Jimin. My matrix number is 1142. Today I will be presenting about association for account payable. For every association, the auditor perform two types of testing. The first one is test of control, which checks whether the company internal control are working effectively to prevent or detect errors. Second is substantively test, which directly check the accounting record and supporting document to obtain evidence that the record balance are correct. Alright, now I will explain each association one by one. For the first association is completeness. The purpose of this association is to make sure that every liability should be recorded has actually been recorded. Why is this important? Because if the company forget or intentionally leave out supplier invoice, the account payable balance will be too low. As a result, the company liabilities and expenses will also be understated and making the company financial position look better than it really is. For the test of control, the auditor verified that every supplier invoice is matched with approval purchase order and good receipt note before it's recorded. This process is called three-way matching process. The purchase order prove that the goods were ordered. The goods receipt note confirm that the goods were received, and supplier invoice confirm the amount that needs to be paid. Only these three documents agree can the transaction be recorded. For the substantively test, the auditor perform a search of unrecorded liability after year end. This means the auditor check payment made after the financial year end. If a payment relates to goods received before year end but was not recorded, it indicates that a liability has been omitted. For the audit procedure, the auditor examines supplier invoice, purchase order, good receipt note, and review payment made after year. For example, imagine a company received office furniture on 28 December, but supplier invoice was only recorded in January. Since the goods were received before the year ended, the liability should have been recorded in December. If it wasn't recorded, account payable is incomplete. Alright, next is existent. The objective here is to ensure that every liability recorded actually exists and is a genuine obligation of the company. In simple words, the auditor wants to make sure the company is not recording fake supplier or imaginary invoice. For the test of control, the auditor check whether the account payable entries are reviewed and approved by authorized personnel before posting. This approval process reduces the risk of fraud because unauthorized or fake invoice cannot simply be entered into the accounting system. For the substantively test, the auditor reconciles supplier statement with the account payable subsidiary ledger. A supplier statement is prepared by supplier and show how much the company owes them. The subsidiary ledger is prepared by the company. The auditor compares these two records and to ensure they agree. The audit procedure is to investigate any different found. Example, suppose the supplier statement show the company owes 25,000, but the company ledger only show 22,000. The auditor will investigate why there is a 3,000 difference. It may be because an invoice was missed or recorded incorrectly. Alright, next is accuracy. This assertion ensures that the recorded amount is mathematically correct. Even if a liability exists, it is still a problem if the amount is wrong. For the test of control, the auditor check whether invoice calculations are reviewed before recording. These include checking quantities, unit price, discount, SST or tax, and the final total. For the substantively test, the auditor recalculates invoice amount and compare them with the general ledger. The auditor performed the calculation independently to confirm that the accounting records are correct. The audit procedure includes inspecting supplier invoice, recalculating totals, and checking that the correct amount has been posted. Right, next is valuation. Valuation means making sure account payable is recorded at the correct value. This is especially important for company that purchase goods from overseas supplier because foreign currency exchange rate change every day. For the test of control, the auditor review foreign currency, conversion, and purchase discount. For the substantively test, the auditor verify that account payables balance are recorded at the correct amount. The audit procedure include recalculating foreign currency translation and reviewing outstanding balance. For example, if the company buy goods worth USD 10,000, the amount recorded in ringgit Malaysia depends on the exchange rates. If the correct exchange rate is 4 ringgit and 30 cents, but the accountant used 4 ringgit 50 cents, the liability will be overstated. Therefore, the auditor recalculate using the correct exchange rate. Alright, next is right and obligation. The purpose of this assertion is to ensure the liability legally belongs to the company. The company should only record debts that is actually responsible for paying. For the test of control, the auditor ensure purchase are properly authorized according to the company policy. For the substantively test, the auditor examine purchase agreement and supplier contracts. This document prove that the company has agreed to buy the goods and is legally required to pay. The audit procedure is to inspect contract, purchase order, and supplier invoice. Example, if another company invoice is accidentally recorded in our company account payable, it should be removed because our company has no legal obligation to pay it. Next is cut off. The objective is to ensure transactions are recorded in the correct accounting period. This is particularly important around the financial year end because mistake can affect both profit and liability. For the test of control, the auditor check whether the purchases are recorded according to the correct accounting period. For the substantively test, the auditor examine transaction before and after year ended. The audit procedure include comparing invoice debt, good received note, and journal entries. For example, goods are received on 30 December but recorded on 3 January. Since the goods were received before year ended, the liability should be recognized in December, not January. Otherwise, expenses and liability for December will be understated. Alright, the last one is presentation and disclosure. This association ensure account payable is properly presented and disclosed according to the accounting standard. This allows user of the financial statement to clearly understand the company liability. For the test of control, the auditor review whether account payable is correctly classified as a current liability. For the substantively test, the auditor verify that all disclosure required by accounting standard have been included. And the audit procedure includes reviewing the financial statement and notes to the accounts. For example, if a long-term payable is incorrectly classified as a current liability, a user may wrongly believe the company has to pay all its debts within 1 year. Therefore, correct presentation is very important.
My name is Yashwini and my matrix number is 06D8024F1188. Today I would like to present the transaction flow for account payable. The transaction flow begins when a department identifies the need for goods or services. For example, the production department may require raw materials or the office may need stationery. Once the need is identified, the user department prepares a purchase requisition. This document contains details of the items required and is submitted for approval. After the purchase requisition is prepared, it is sent to the finance manager or department director for approval. This approval is important because it ensures that only necessary and authorized purchases are made. Once management approves the request, the purchasing department prepares and sends a purchase order to the supplier. The purchase order includes important information such as the item description, quantity, agreed price, and delivery date. When the supplier delivers the goods, the receiving department inspects them to ensure that the quantity and quality match the purchase order. If everything is correct, a goods received note is prepared as evidence that the goods have been received. Next, the supplier send an invoice to the account payable or finance department. The invoice is checked carefully to make sure all the information is accurate. After that, the account payable department performs a three-way matching process. This means the purchase order, the goods receipt note, and the supplier's invoice are compared. If all three documents match, the transaction is considered valid and can proceed to the next stage. Once the documents have been verified, the company records the transaction as an account payable liability in the accounting records. Finally, the finance department approves the payment and pays the supplier according to the agreed payment terms. This completes the account payable transaction flow. From an auditor perspective, this process is important because it ensures that every purchase is properly authorized, supported by valid documents, accurately recorded, and protected against fraud or duplicate payments.
For account payable, we have more example for supporting documents, such as purchase requisitions, purchase orders, goods received notes, and supplier invoices. These documents track our buying processes from the start until we receive the item. Assalamualaikum. My name is Sharifah Salma. My metric number is 1041. So right now I'm going to continue the presentation to explain about the supporting document. First of all, it's about supplier statements. This document shows all our past transactions and how much money we still owe to the supplier. We use this to double check that our account balance are 100% correct. We also use three-way matching to match our orders, receipts, and invoices. After that, we update the account payable ledger and prepare a payment voucher, and bank will transfer advice to complete the payment. Moving on to purchase orders. Purchase orders is an official document sent to a supplier to confirm our order for goods or services. It proves that the purchases was approved by the company before we buy it.
In conclusion, account payable is an important part of a company's current liabilities. It ensures that all amounts owed to suppliers are recorded correctly and paid on time. Good management, proper internal controls, and accurate auditing help prevent errors, avoid fraud, and maintain reliable financial statements. Therefore, accounts payable plays a key role in supporting a company's financial health and business operation. Next is bank overdraft. A bank overdraft is a short-term credit facility provided by a bank. It allows a company to withdraw more money than the available balance in its bank account. This helps the company manage temporary cash shortage and continues its daily operations. A bank overdraft is classified as a current liability because it is repayable on demand or within 1 year.
Alright, now I will continue with the audit session for bank overdraft. The first one is completeness. The objective of this session to ensure that all bank overdraft facility and balance has been completely recorded in the accounting record. The auditor wants to make sure that the company has not omit any overdraft accounts or outstanding balance. This is important because if an overdraft is not recorded, the company liability will be understated. As a result, the financial statement will show that the company owes less money than it actually does, which can mislead investor, creditor, and other user of the financial statement. For the test of control, the auditor check whether all bank account and overdraft facility are recorded in accounting system. Management should maintain a complete list of all bank accounts and regularly review it to ensure no account are missing. For the substantively test, the auditor verified that every bank overdraft balance is included in the financial statement. This is done by comparing the accounting record with information obtained directly from the bank. The audit procedure is to obtain bank confirmation and review bank reconciliation. Next is existence. The objective of this assertion is to ensure that the recorded bank overdraft actually exists and is a genuine borrowing provided by the bank. In other words, the auditor wants to confirm that overdraft shown in the financial statement is real and not a fictitious or incorrect balance. For the test of control, the auditor checks whether the overdraft facility has been approved by authorized management. Normally, only director or senior management have the authority to apply for approved bank overdraft facility. This control help prevent unauthorized borrowing and reduce the risk of a fraud. For substantively tests, the auditor obtain direct confirmation of the overdraft balance from the bank. The audit procedure is to send a bank confirmation request to verify both the existence of overdraft facility and its outstanding balance. Alright, next is accuracy. The purpose of this association is to ensure that the overdraft balance, interest expense, and any related bank charge are recorded correctly. Even if the overdraft exists, it will still be incorrect if the recorded amount or interest calculation is inaccurate. For the test of control, the auditor review how management calculate overdraft interest and related charge before they are recorded. For the substantively test, the auditor independently recalculate the interest expenses and compare it with the bank record. The audit procedure includes inspecting the bank statement and recalculating the interest charge using the interest rate stated by the bank. Alright, next is valuation. Valuation ensures that the bank overdraft is recorded at the correct amount at the reporting date. This means the outstanding overdraft balance and any accrued interest should reflect the actual amount owed to the bank. For the test of control, the auditor reviewed the monthly overdraft balance and interest calculation prepared by management. Regular monitoring helps that detects error before the financial statements are prepared. For the substantively test, the auditor compared the year-ended overdraft balance with the balance confirmed directly by the bank. The audit procedure is to compare the general ledger balance with both the bank statement and the bank confirmation. Alright, next is right and obligation. This objective of this assertion is to ensure that the company has legal obligation to repay the bank overdraft. The auditor wants to confirm that the overdraft belongs to the company and is not another company's liability. For the test of control, the auditor check whether the overdraft agreement have been properly approved by the management before they are signed. For the substantively test, the auditor examines the overdraft agreement, loan document, and bank facility letter. The documents are provide evidence of the borrowing limit, interest rate, repayment terms, and the company legal responsibility. The audit procedure include inspecting bank agreement, facility letters, and board of approval. Alright, next is cut-off. The objective of the cut-off assertion is to ensure that all bank transactions are recorded in the correct accounting period. This is important because transactions occurring near the year ended can easily be recorded in the wrong financial year. If this happens, both liability and finance expenses may be overstated or understated. For the test of control, the auditor check whether the management record bank transaction according to the correct accounting period. For the substantively test, the auditor examines transactions occurring immediately before and after the year ended. The audit procedure includes reviewing bank reconciliation and inspecting year-ended bank transaction. Alright, for the last one is presentation and disclosure. The objective of this assertion is to ensure that the bank overdraft is properly classified and disclosed in the financial statement according to the accounting standard. Normally, bank overdraft are classified as a current liability unless accounting standard require a different classification based on the term of overdraft. For the test of control, the auditor review whether the management has classified the overdraft correctly in the financial statement. For the substantively test, the auditor verify that all disclosure required by the accounting standard have been included. The audit procedure includes reviewing the financial statement and notes to the amount, and the auditor checks whether the information such as the overdraft balance, repayment terms, interest rate, and any security pledged to the bank has been properly disclosed.
Now I would like to explain the transaction flow for a bank overdraft. The process starts when the finance department identifies that the company requires additional short-term funds due to insufficient cash. The finance department then prepares a bank overdraft application together with the necessary supporting documents such as financial statement and other required information. After the application is completed, it is reviewed and approved by the finance manager or director. This approval ensures that the company has properly authorized the borrowing before it is submitted to the bank. Once approved, the finance department submits the application to the bank for evaluation. The bank officer then reviews the company financial position and performs a credit assessment to determine whether the company is eligible for the overdraft facility. If the company meets the bank's requirements, the bank approves the overdraft and grants the facility. After receiving approval, the company can use the overdraft to finance its daily operations or pay short term obligations when cash is insufficient. The accounting or finance department records the overdraft as a current liability in the accounting records. Finally, when the company has sufficient funds, it repays the overdraft together with any interest charged by the bank. This completes the bank overdraft transaction flow. From an audit perspective, auditors will ensure that the overdraft has been properly approved, accurately recorded as a current liability, supported by bank documents, and repaid according to the agreed terms. Thank you.
Now, let's look at bank overdraft documents. First is the bank statement. It shows our actual overdraft balance at the end of the month. It acts as official proof of how much money we owe to the bank. Next is bank reconciliation statement. We prepare this to match the balance in our company's books with the bank's records. It ensures that our reported bank or overdraft figures are accurate. To set up and monitor our overdraft, we need these documents: the bank overdraft application form, board resolution approval, financial statements, and the final bank approval letter. Lastly, for daily tracking, we rely on the monthly bank statement, payment vouchers, interest statements from the bank, and also our own general ledger. That's all for me. I'm going to pass this presentation to my friend.
For the conclusion, ensure the overdraft assets is accurately recorded and properly disclosed as a current liability. Evidence is obtained from bank confirmation, overdraft agreements, and reconciliations, and interest recalculations.